Hey, Saretsky here. Welcome back to the show. Quite a few things to touch on this week. I want to touch on what's happening in the labor market, how that's influencing the bond market, bond yields, which influences mortgage rates, which implements and impacts home resales, and again, some updates on the rental market, things that we've been tracking very, very closely on the show for a long time now. So, first and foremost, you had the jobs data that came out today, the day that I'm recording. Huge beat in jobs, headline jobs, adding 54,000 jobs in this country last month. That's up. That's another strong number, 66,000 last month. So all of a sudden you have this screeching hot labor market. The unemployment rate, again, everyone's been expecting the unemployment rate to move higher and higher and higher. So the unemployment rate was expected to come in at 7%. It fell. It fell from 6.9 to 6.5%. So again, the unemployment rate is going down. Why is the Bank of Canada cutting rates? All of a sudden, the labor market is strengthening. This goes in complete contradiction to what everybody has been predicting or expecting. And particularly if you look at the YouTube comments here below, I can guarantee that everybody's expecting, the unemployment rate to move to double digits. That has been basically the sentiment in the space. So exactly what is happening? Well, good friend of the show, Ben Rabideau, eloquently points out that you have two labor force basically data sets. You have the labor force survey, which is the one that came out today, which is showing a strong growth and rebound in the labor market. Then you have the survey of employment payrolls and hours. And so if you look at those two data sets, they are diverging in completely opposite directions. So now you effectively have to pick one and say, well, which one do you believe? They can't diverge forever. So one of those surveys, one of those data sets is wrong. Okay. My bet personally is on the StatsCan survey of employment payrolls and hours. Clearly, I think when you read the news and you look around you and you ask people and you talk to people, I think everybody's worried about the economy. I think that there's no really any business today that is having a record banner year. I am, of course, in the real estate space. That is a space that is getting decimated, that continues to basically lay off people. There is very, very little activity happening. You look at the public sector, you can look at the municipal level, the provincial level, and even the federal level. All of them are announcing job cuts to the public sector, which is incredibly, incredibly rare. So as you start to wonder, where is the growth going to come from? And so again, I would lean towards that other survey likely being more accurate. But that ultimately leads into the next point, which is effectively, well, hold on a minute. You have financial markets that trade and price based off of these data sets. And again, I would argue that the data set is incredibly noisy. We call it the StatsCan random number generator for a reason. But ultimately, you had the Canada 5-year bond yield. That is what prices Canada's 5-year fixed mortgage rates. It moved up 17 basis points today. 17 basis points in a single day is an enormous move. And so starting next week, you'll probably see mortgage rates push up probably anywhere between 5 to 10 basis points next week. And so again, I think this is really, really important. My view is ultimately this data set should probably be faded, but financial markets are now starting to say, oh, reposition. And the narrative is effectively, again, depending on what data set is right, if it is in fact the labor force survey that came out today that's accurate, then we've seen probably the lows for mortgage rates and certainly the last cut from the Bank of Canada. Now, again, that's not necessarily my view, as we've just discussed earlier, but I think it's worth keeping an eye on. So that's exactly what's happening in the labor market, in the economy. I'm going to shift gears to sort of the housing market, again, which I think it plays an enormous role in the economy, in the wealth effect, and in overall sentiment. And what we continue to see, and when you look at the numbers that come out for the month of November, home sales across Greater Vancouver down, Toronto down. We are tracking the fewest home sales for the year, not for the month or for next month, for the year. So for 2025, we are on pace and will most likely hit the fewest number of home sales since the year 2000. So you're effectively looking at a 25-year low in new home sales for the year. That is how weak the resale market is. Inventory remains at 8 months for sale. Of course, this has basically created the scenario that we've talked about, which is The resale market's very weak. It's allowing inventory to build. You now have 8 months of inventory on the resale market, which is effectively double, just over double of what we're used to, which is why homes are taking a very, very long time to sell today. And this is ultimately, of course, has shut off the ability for developers to sell new units and has forced them basically to convert to rental. Of course, we're now starting to see, as we've talked about, well, hold on a minute. Rents are declining. Population growth, as we know, over the next couple of years is going to go to zero. We had a big, large developer in the city this week. I'm not going to name any names, but one of the largest rental developers that has now trimmed about 25% of their staff in the last couple of weeks. And so you know that that is a key sentiment or an indicator that that gravy train on the rental side is now also starting to shut down. So there's an inability to hit pre-sales, and now there is becoming an inability to hit rental targets, making these pro formas effectively null and void, which is effectively to say, um, as these projects complete with rents down, call it 10, 12, 13%, rising vacancies, making these units harder to rent out, rents come down. You now have larger equity injections into these projects and grinding down investor returns, making these projects, in many cases, no longer viable. So, again, we continue to believe that housing starts, new housing construction is going to roll. It's going to roll off a cliff over the next 18 to 24 months because that data set is a very lagging indicator, is a very lagging data set. A housing start is once the foundation is built back to grade. So again, a very lagging indicator. We know with falling prices, falling rents, and the carnage that's happening in that development sector, that this is going to roll. And this is why in the same week, we had an announcement from the city of Vancouver saying that they are now going to be trimming development fees immediately to basically arrest the carnage that is happening in the construction space. Development fees are going to be cut by approximately 20%. Again, because if you think about it, even from a city's perspective, you talk about these housing targets that, they want to hit and other levels of government want them to hit. You talk about even tax revenues, right? Development fees. I mean, if you cut development fees by, let's say, 20%, well, 80% of something is better than nothing. And that's the course that we're on, which is effectively very little to nothing is getting built starting now. And so, the cities are basically being forced to cut the development fees to at least keep some projects. Again, it ain't going to move the needle very much, but it's going to make projects that are on the fringe, it's going to make them at least a little bit slightly more viable, that some of them might still squeeze across the finish line. And so I think that's another really, really just important. These are all just like signposts. These are things that you should be paying attention to. You say, well, why are they changing now? Why am I reading this now? And what are the implications? So this is what we're seeing on the ground. And I think when we look at this labor force data and what's happening in the bond market, I think that ultimately this is what we've been talking about is, listen, like, we're now in this new era where there's a lot of government debt issuance, massive deficits, huge issuance on the debt side, that you're going to have a lot more volatility in rates markets. And so I would actually point to a really interesting chart. Friend of the show, Stephen Planoisi, pointed out that is from the Bank of Canada, effectively showing the huge growth in hedge funds basically buying Canada's government debt. And this is kind of like more speculative purchasing, right? It is, these hedge funds aren't necessarily like long-term holders. They're more fickle to changes in headlines. And I think that ultimately is part of the reason perhaps why you saw a massive 17 basis point move in the Canada 5-year the day of the announcement, which is, again, so I think ultimately what this means for, the average person is to say, listen, I think you're just going to have, in general, more volatility in rates markets today and moving forward. And this is really just important for people that are coming out for mortgage renewals. We know that in 2026, it is the largest. It is the largest share of mortgage renewals in Canada is happening in 2026, not in 2025. But in 2026, it's actually going to be even larger. And so people that are deciding between, variable rates and 3-year rates and 5-year rates, just know that you should expect more volatility and larger swings, such as we saw today on data that is a little bit suspect, still moved markets in a big, big way. And so the Bank of Canada is on deck next week. Of course, markets are expecting no cuts from the BOC. There are no cuts priced in for 2026. So again, if you're a home seller and you've made some mistakes betting and hoping and thinking that the Bank of Canada was going to bail out the market, that was going to suddenly turn, home buyer demand around and rising prices, that might be what you're used to. But I think that, again, we're now in basically going into year 4. We're going into year 4 of the housing correction. We know that home prices peaked in February of 2022 across this country. And we are now going into year 4. And too many people have made the mistake of basically hoping that rates would move lower and lower and lower, and that would bail out the housing market. But again, just because the Bank of Canada has moved, we've seen that bond yields have been very sticky. And despite all the volatility this year, mortgage rates have effectively been range bound, effectively stuck at 4% today. So, as always, that's kind of what we're keeping an eye on moving forward. I would say fade the labor market fade the labor market data, but important context as it implicates bond yields here moving forward. So, as always, see you next week.